we had a strong quarter with 25% growth vis-a-vis the first half of last year. But coupled with growth, we've seen profitability, return on tangible equity at 17%, business volumes going up by 38 billion in the quarter, and a very good level of capital generation with another share buyback and 60% payout announced. I would say, turning to the housing point you mentioned, there's a clear pickup in at least our lending volume is up more than 40% in terms of new lending production, new mortgage production in this first half of the year. And this is clearly a result of stability in interest rates and the prospect of a slight fall in rates and indeed good degree of confidence on the demand side and the scarcity of supply on the other side. So we expect that trend to continue for the foreseeable future.
Some strong numbers as well in your order book, despite the higher rates that are still persisting, yes, anticipated to indeed go higher. Are you expecting to continue to see a pickup then in that order book as those rates continue to drop off over the longer term?
We factor in what I would say is an inflection point in terms of loan demand in Spain, both mortgages, but particularly businesses and also consumer are clearly indicating a new cycle of growth. If the economy continues to do well, as it's doing very well in the case of Spain, what we expect is not just sustaining the current levels, but an acceleration of loan demand in the next quarters and years.
Gonzalo, lovely to see you today, sir. What do you have concerns about? I look at the Spanish market and I think many of us are really excited to see the strengths of that sector that has had so many troubled times over the years as well. But where would the concerns be at the moment? Because it seems, compared with many places, including Northern Europe, things look pretty good. They
are indeed, Steve, thank you. And we have to be happy to see, basically yesterday, we had GDP numbers up 0.8% in just a quarter. We are very likely to increase our estimate of GDP beyond the 2.4% for this year, 2024, that we had previously estimated. There's always concerns for us. It's our job to think about risks and what maybe, I would say, in the current scenario, geopolitical risks and the sort of global environment are probably the ones that are of most significance to us.
What about the comments from Mr. de Guindos as well? He would love to see a wave, and I'll quote, "National bank mergers must become cross-border deals." I know you know Mr. de Guindos. It's a very tight circle at the top of Spanish banking as well. Do you point out the obvious points that actually, because of the lack of joined-up thinking, because of a lack of CMU, because of the lack of a single banking union as well, it's not actually viable to do what he wants?
Well, I would say consolidation cross-border still has to prove its case in terms of value creation. We have proved the case for value creation in domestic consolidation. We delivered €1 billion of synergies after the integration of Bankia just 3 years ago. And that was obviously widely seen as a big success. When you look at cross-border transactions in retail, there's no real precedent where synergies in relevant size have been created. And obviously, they generate complexity. We still have Europe that, as you said, lacks a single banking market and a capital markets union, but also we still see that retail banking is actually fairly local in terms of customers' demand and preferences, but also in terms of commercial law, in terms of bankruptcy, in terms of consumer protection. So there's a lot of work to be done so that the environment is more conducive to cross-border consolidation, I would say.